I'm Lori Scott. I'm the Chief Credit Officer of the Impact Investing Team at the MacArthur Foundation. We are a $7 billion private foundation located in Chicago, and we have about $500 million that's dedicated to impact investing. We have a number of different strategies that we engage in our impact investing. One of them is called Benefit Chicago, where we're in a partnership with two other organizations where we have a $100 million fund that's just for Chicago. MacArthur has invested $50 million of that $100 million, and it's a partnership with the Chicago Community Trust, which is our community foundation in Chicago, as well as Calvert Impact Capital. There's folks from Calvert Impact Capital here, and they have a retail note that we're using to raise money. And then MacArthur Foundation has other impact investing strategies that I won't go into now. So first I'm going to very quickly introduce our panelist. I'll make a couple remarks, and then I'll let the panelists speak on the topic, and then we have some Q&A. And I think, I don't know if you said this, but we're going to hold the questions from the larger group until after the second panel, because otherwise I don't think you guys would have like a 10-minute panel. So we'll try to be respectful of the time. So first, we have John Townsend, who's a trustee and chair of the finance committee at the 105-year-old Altman Foundation, a private foundation. And the Altman Foundation has been making PRI investments for 15 years.
Close.
Yeah, with a focus on New York City. And John also recently served on the Planned Parenthood board and chaired several committees there. Then we have Miriam Robel, who is a consultant based on the West Coast, focused on clean energy project finance. So we have a very specific sector focus here with the specialty in energy efficiency projects. And she works with folks along the value chain with lenders, investors, large energy users, and utilities to structure transactions that align the various interests of the group. And we have Quinn Moss, who is the co-head of Orrick Harrington's Private Investment Funds Group, and she's on the steering committee of Orrick's Impact Finance and Investment Group, and also on the board of Highwater Women. So I think we all owe you some thanks for bringing us together today.
Well, thank you for coming today.
Yeah, and this is my first
Indeed.
Highwater Women conference, and so far I've been very impressed. There's a lot of great energy here. So just a couple of very quick comments. What are we talking about when we say sustainable cities? We have a very broad definition here that's inclusive not only of the environmental issues, but also economic justice issues and all of the different elements that create a city that is durable and sustainable and allows people to achieve their best selves. Not to be Oprah about this. It includes multiple sectors and themes. We're talking about affordable housing, energy efficiency, economic development. It touches on, multiple SDGs, as we know, especially given the terrific panel before this. And our panel has very diverse perspectives. This is the asset owner panel, this first panel, and you guys are the practitioner panel, or we'll let you describe yourselves. Yeah. And so we have a variety of roles, both as owners, decision makers, et cetera, and collectively reflect several different sectors: the arts, the environment, affordable housing, and we collectively work across asset classes. So for those of you who have particular interest and focus, we're happy to address your questions there. One final plug before I let folks truly speak. The Urban Institute has done some great work on place-based investing. If this is a topic of interest to you, if you're working in this, or if you're exploring it, please check out their work. They've been collecting case studies and models and best practices across the country. And it just, even having been working in this place-based investing for many years, it blew my mind how many exciting things are going on and how much innovation there is out there. So each of you have an opportunity to speak. John, do you want to kick us off?
Sure. Most important thing I have to report is that you are sitting in the former home of a department store called B. Altman and Company, which those of you of a certain age will remember was in this building for 80 years. This gorgeous. If you noticed coming in, landmark building for 80 years before the store was sold in 1984. And we are somewhere where inventory for
The
the
maids'
department store, which is 6 or 7 stories, was held. So I'm grateful to High Water Women for inviting me and for being included on this panel. And I didn't realize at the time that I was going to come to the very building, which is the origins of the foundation. In fact, the foundation's principal asset until 1984, when the store was sold, was B. Altman and Company. Anyway, we are focused. We are 10 blocks from here, located in New York City, and focused all of our grant making and all of our financing in the 5 boroughs of New York City. And the lion's share of that has been program-related investing, which is, does everybody know what program-related investing is? Should I?
Don't be shy if you want to hear a quick definition.
Maybe it warrants a 30-second explanation. It's a provision, actually a provision in the tax code, which allows foundations, both any kind of foundation, private, family, to take the principal amount of an investment, whether it's a loan or an equity investment, as having it count against the required 5% distribution requirement. And then when it's repaid or when the investment is realized, it sort of comes back and incentivizes the foundation to recycle the funds. So we have a substantial commitment in this market, and we've been doing it for close to 15 years and are actively engaged in recycling the money. Most of our deals have been, in fact, all of our deals have been debt deals, loans, to usually real estate related projects in the city. I'll give you an example, the most recent loan that we participated in along with several other foundations, I'll come to that in a second, was to Gina Gibney Dance Studios. Some of you are nodding your head. Gina Gibney, for those of you who follow the dance world, is a major name in New York City dance, and an absolutely brilliant woman, not only artistically, but a great businesswoman. And she successfully, through city grants and negotiation with us and other subsidized lenders, succeeded in building out space in Lower Manhattan on Lower Broadway, which is then made available at greatly subsidized rents to struggling dance amateur and professional nonprofit dance companies. Actually, the business model is kind of interesting because she also leases the space or rents the space to Broadway dance companies who pay top dollar and even top dollar plus, which in turn subsidizes the rents that she charges much less deep-pocketed dance companies and nonprofit dance companies. A lot of the things that we have done are real estate related. Why? Because real estate, depending of course on how it's developed, tends to produce income, which becomes for us a source of repayment of the loan. We are part of we decided 4 or 5 years ago to become part of a pooled PRI fund in the city, and we were instrumental in helping establish what's now called the New York Pooled PRI Fund, and it includes 9 foundations in New York who are located here and focused on philanthropy in the city. it's been a very, very successful collaboration, and one of the reasons is we've centralized the due diligence, credit review, and legal expenses into one entity, which makes a lot of these transactions far easier and far more doable. It's the New York Pooled PRI Fund is run by a nonprofit called Sea Change, which is a nonprofit, styles itself as a nonprofit merchant bank, and they have done all the work for us. We're 1/20th the size of MacArthur. We don't have the staff to do all this stuff ourselves. We have two in finance, on the finance staff, and we just don't have the capacity or even the capability to do that kind of work, and so, nor to generate the transactions. In the PRI world, you just don't hang out your shingle and say, we're here to make loans. It doesn't work that way. You need to go out and source deals, solve problems, come up with creative solutions, and Sea Change is really the focal point for our doing that. Plus, we're able to pool capital resources of 8 other foundations. The fund is structured as an opt-out vehicle, so any foundation that does not want to participate for various reasons, whether they don't like the credit or it's not in line with their mission, has the ability to opt out. Why don't I stop there and without
Great, that's
saying
really
anything
helpful.
more.
Thank you. We'll dig into some of those topics in a bit. Ma'am?
Hi, I'm Miriam Roble. I'm a recovering banker, now a consultant on my own, working with both the investor side and the end user side of the energy world. So on the investor side, I work with state green banks, I work with private equity investors, I work with utilities that have money to spend in the space on creating investments that really achieve energy efficiency goals, energy resiliency goals, and other policy goals on a state-by-state basis. On the city side, I work on everything from trying to solve in New York City how small businesses get energy efficiency project financing, everything from light bulbs to HVAC, and how you take a massive amount of small businesses that don't really have credit and give them loans at an affordable rate to do energy efficiency investments that are really low risk. So we all know that if you change out lighting fixtures, it pays back in a year or two. Things like that that they can't get money for. So always trying to look at who's doing what in the market and seeing, can you apply this to energy? The way I ended up here is that Imogen invited me because the University of California is one of my clients, and I'm working with them on strategies for financing large projects throughout the system. So Imogen and I are the big whale we're trying to tackle right now is taking one of the UC campuses and making it net zero energy, or zero carbon footprint. That is a big task, and it hasn't been done before. All of the infrastructure and private equity guys are buzzing around it, but we think that it's a great place for an impact investor. So, from hundreds of millions of dollars that project is, to these individual loans to small, to nail salons for $5,000. Of course, in aggregate, it's a much bigger deal. But that's where my practice spans and where my interest lies. Miriam Roble.
Thanks, Miriam. Quinn?
Hi, everyone. So I'm the lawyer on the panel. And ORIC is a global law firm, and our impact practice is also global. We have people that work on sustainable fisheries in Indonesia and deforestation projects in Africa. I personally am primarily domestic, although a couple of my projects are in Asia. I am the co-head of our funds group, so I come to this with a funds lens. And it's been a very interesting learning process for me because the funds that I tend to work with historically have been equity. And as you've heard already from our panelists, and as you probably know from the market, most investments, or many investments in impact, are structured as debt. And so I'm also active with Jin's project on hybrid finance because actually to make many projects scalable and bring in more private capital, you actually have to be very creative. You have to bring in the debt, you have to bring in the equity, you have to bring in first loss guarantees, you have to bring in all sorts of things to make every actor at every tier comfortable with their role in producing the impact. And so that's my role. My role is to help structure and try to do the hard work that it takes to make many of these projects work. I started off in the space not knowing it was impact. I represented a nonprofit doing affordable housing funds, again, on the equity side. It was a number of years ago. There was a concessionary return, but a high pref. And so the investors in that fund thought, okay, as long as I get my pref back of 9%, I don't mind if my overall return somehow is depressed. You go forward now, and much of what you hear in the market is you don't need a concessionary return. And I should pause on that because I'm not sure I agree with that. I mean, I think you can be very creative with structuring projects to bring in large amounts of capital, but there needs to be a room in the market for the whole spectrum. And the most important point is to get the impact and to persuade the right players to play their role so that you get the right group of people working together towards that end. Other examples of the kinds of things I've done, I also work with a group actually in Chicago that is a CDFI. They asked, as soon as the Opportunity Zone opportunities came forward in the last Tax Reform Act, they said, do you think that's something we can think about? And I said, probably not, because you're on the debt side. You have new market tax credit access, but this is largely to bring in equity capital into the cities, long-term equity capital. But there's other clients. So I have another client in the Pacific Northwest who works in affordable housing, which translates to actually manufactured housing in the Pacific Northwest. There is a really strong potential for attracting Opportunity Zone type capital. So, I'm basically straining to use all the resources that I've gained from over 30 years of practice to put into these different structures, because it needs a little bit of a lot of things to make any of these things work. What I hope for the impact world down the road is that there will be a number of templates that will work more quickly and easily for more people, because that will definitely attract more capital, and that we can also eventually work towards the same metrics and reporting, or at least something similar, so that you feel more comfortable with what you're getting. I'm working on a fund for a very large investor in a very large global impact fund right now, and the sticking point really is the reporting. The private equity manager, very, very well-known private equity manager, very, very strong equity manager, is reluctant to come down with metrics that they're willing to match to the SDGs that they can deliver on every investment. And on behalf of my investor, my goal is, no, this is what makes it an impact fund, actually, is that I can measure the impact you're achieving. It's not enough to give me a bunch of numbers about where things are. I need to know, what do those numbers mean, and what impact have you achieved, whether it's environmental, educational, health, whatever the SDGs that they're choosing. So I'm kind of the cop. I'm how do you identify the impact you want to achieve, how do you structure it to achieve it, and then how do you measure that you actually have achieved it? So that's my role.
Thank you. So our panelists have surfaced lots of topics that are common to impact investing strategies globally. And I'm glad you brought up opportunity zones and talking more specifically in New York, and we'll have some questions around that. But first I wanted to jump on your point about concessional capital, because that's the world we live in, making program-related investments. There's got to be something there, and totally agree that there needs to be there's a range of projects and opportunities, and should be a range of expectations from the investors. There's certainly lots of investable opportunities that don't yield double-digit market returns, but yield a solid single-digit return that's very reliable. So I'm glad you brought that up. So I wanted to thank you for introducing yourselves and talking generally about your work. Wanted to talk about the heart of the topic here in terms of sustainable cities. And first, Miriam, I wanted to ask you a little bit more about the energy deals. And tell us what you think investors might be missing about energy deals, especially in the context of sustainable cities.
Sure. I think there has been some history with energy deals. You had in the 70s and 80s, the ESCOs came out, and Siemens, Johnson Controls would do these big projects. And a lot of public sector agencies got burned, a lot of customers got burned. And there's been a lot of misconception about the risks involved in energy deals. And they're actually pretty low risk energy efficiency deals or storage. Solar and wind, they figured out really well how to quantify the risk, and in energy efficiency and other, less clear, solar and wind are producing energy. When you do things that save energy or change the time that you use it, it's a little fuzzier. But there is this sense that there's a lot of risk of it going bad. And the nice thing is that there are a lot of engineers who can give you opinions that are pretty reliable. So in the solar and wind space, it's really common to have an independent engineer. When I was a banker, we always had an independent engineer on a deal. And I'm trying to bring independent engineers to the efficiency space in a larger way, because it's a way that investors can rely on some of the promises being made. And a way also that there can be a less asymmetry in the market of doing energy deals. So this is going to become more and more important, because the energy world is moving from a structure where big power plants make energy and send it out to more of a bi-directional, it's being produced on site, it's being stored on site, you want to have efficiency. This market will need a lot of capital that understands the risks inherent in this distributed market. And there are lots of ways that we can get there, but a big misperception that I'm out talking to both investors and end users about is that you really can rely with a high degree of certainty on certain performance in energy efficiency and energy storage, microgrid type deals.
Thank you.
Sure.
So Quinn, I'm glad you brought up opportunity zones, because I don't know about you, but I've heard a lot about opportunity zones. And you may have seen Rockefeller Foundation and Kresge Foundation had an open call, and there was a deluge of proposals. But yet the regulations really have not been made clear. So we don't really know, what we're working with here. There's the potential for this tax benefit to drive lots of resources to low-income communities, but I certainly have a lot of questions out there. And I know, John, you had said that you guys perhaps are thinking about this, and Quinn, maybe you could further address this as well and share with folks how you're thinking about this, especially in the context of cities.
Want me to go first? When Laurie mentioned that she was going to raise this topic, I thought, whoa, I don't know very much about opportunity zones. I better go on the web and find out. And when you do, although I'd certainly heard about them, when you do that, you find out that your first 15 results of your search are from people raising funds to invest in opportunity zones, even though the tax treatment isn't completely clear, and Treasury, the IRS hasn't issued their their guidelines, which made me skeptical and suspicious. It's not a bad thing, it's just that I'm skeptical and suspicious. Then I looked at the map of New York City and the opportunity zones that have been laid out in New York City, and one of them was in Midtown Manhattan on the west side. So I thought to myself, guess where capital is going to go for opportunity zones? It's going to be concentrated in areas that you might argue don't need it. Now, this is, I'm sorry to be so skeptical and cynical about this, again, because it's not a bad thing, but I really wonder whether all this capital steered in the way it's being steered is going to be productive, certainly in the way impact investors or those who care about the social impact of these funds will want. So words of caution, at least from where I sit, but personally as head of the finance committee at a foundation, be really careful if you're going to invest in vehicles which are steered toward opportunity zones. Be careful and carefully evaluate where those funds are going and who's going to be responsible for them. It's like investing in, we're looking at currently a mission-related investment, which is not concessionary, which is for the preservation of affordable housing in the city. And there's a whole range of possible outcomes in that field generally, from what is often called predatory equity, where the owner of the developer is suing all the tenants and throwing them out on the street so he or she can raise rents, to a very responsible property improvement and operation. And it's due diligence on the developer, and I would imagine with opportunity zones, the same thing, same words of caution will apply, particularly for impact investors. Now, if you're sitting there and you don't care about any of this stuff, and you're sitting on a large capital gain which you want to deploy and defer, maybe it's great, but impact investors, be careful.
So maybe I should just provide a little bit of a primer, because maybe not everybody has spent the time yet on the website. But the idea behind the Opportunity Zone was throughout the 50 states and in a number of territories, I think 5 ultimately ended up on the list, was to have the governors of those states designate census tracts that are essentially on the poverty line. And so after all of that work was done, there are more than 8,000 of these that have been designated, and all of Puerto Rico is an opportunity zone. And I think one of the numbers I heard was that 12% of the U.S. landmass is actually an opportunity zone. But another interesting fact I heard was that some of the opportunity zones out west are larger in landmass than some of the northeastern states. So, but it's intended to address sorry? Yeah. To really address poverty and unemployment in rural areas and in distressed urban areas. And what's interesting about it to me is that it's actually much more forgiving in a way than the new market tax credit incentives, which are, if you violate it, you lose your ability to get an allocation of those credits, and the allocation of those credits are limited to a dollar amount. The Opportunity Zone approach is all money is welcome. And the idea is if you have long-term capital gain, and with these incredible markets that many folks have experienced over the last number of years, there's probably a lot of built-in appreciation that could be cashed in. You can essentially, within 180 days after you've sold that asset, so let's just say it's a stock, so you sold your Facebook that you held and it appreciated. Within 180 days, as long as you put that money into what's called a qualified opportunity fund, and that could be just your own LLC, or it could be one of these funds that's out there marketing themselves right now. And then that fund goes on to invest equity in qualified opportunity zone businesses. Then you have the ability, in fact, to defer your gain for up until 2026, which is a nice long period. You also have the ability at year 5 and 7 to, this is going to sound a little taxy here, but increase your basis so that when you do sell it, you have less of a gain. And this, I'm sorry, increase your basis in your fund. So first you had a gain on the sale of a stock. So let's say you started at 10, you sold it for 110, so you have $100 of gain. You put that $100 of gain in a fund, a qualified opportunity fund, and over time that fund, because of what it's invested in, has appreciated in value. You still only have zero basis. So if it appreciates to 200, now you have a whole nother bunch of tax to pay. What the tax law does is actually let you increase your basis a little bit so you have less tax to pay as long as you hold on to it for a long period of time. And then the third benefit it gives you is that if you actually hold it, the fund investment, for more than 10 years, so 11, 12, 13, 14, whenever, you pay no tax on any of the appreciation. And so it's very rare for there to be a tax plan that gives you both a deferral and, in fact, a total exemption. And this is a program that does that. So John and I had a little discussion beforehand. So why, with this administration, are we getting this kind of plan? And so the skeptics are saying, you know, it is clearly, and most of what you see in the market is real estate development. That's maybe a bad thing and maybe a good thing. Because part of what you have to do with distressed areas is have that modernization, that reinventing of the area. A lot of our infrastructure, including our housing and buildings, has not been paid attention to since the mid-19th century. I mean, most of what you see when you upstate New York is say 1868, 1898 buildings. Nothing has been done since. And so those buildings, in any event, but the question, and John asked the right question, is what is this qualified opportunity zone business? How do we know that as impact investors, we're actually not just helping wealthy developers get wealthier? And so we are waiting for the IRS to come out with more guidance on what it means. But for one of these funds to be qualifying for all of these nice tax benefits for the investors, they have to put 90% of their money into these kinds of qualified opportunity zone businesses. And the qualified opportunity zone businesses, in turn, need to actually be putting most of their money to address the needs of their community. How that's all going to be measured and reported and monitored is still open. So that's why there's a lot of money on the sidelines right now. But it could be one very positive thing if it's done well, or it could be more of the same nonsense. So
I personally found that very helpful. So we have time for one last question before we switch to our next panel. And so working in sustainable cities, impact investing in this context, you're not alone. There's lots of other stakeholders. So how do you work with other stakeholders, civic leadership, other investors, et cetera? Anybody have a comment on that topic? You see them as a resource, or the negotiations that need to happen, et cetera?
Well, I can jump in just quickly on affordable housing, especially if you're redeveloping affordable housing. You can't do it really without the state and the city, because they're providing some of their own built-in incentives for it all to make work, all to work economically. And so what I have seen when I've worked with nonprofits in the area is that there's a very, very tight partnership with everybody working together towards that end.
There are a lot of stakeholders in energy deals. In some markets, there is a lot of tension between the utilities and the users, or some alternatives to the utilities that are springing up in California especially. There are also a lot of procurement hurdles that come about when you're trying to do a major project in a city or on a campus or a medical center campus. which I consider to be small cities. So bringing folks along is really important, but also making sure that if there's a new paradigm where the grid is running itself, the utility and the folks who are becoming less and less relevant are brought to the table, and you figure out a way either to keep them relevant if you need them to get your deal done, or appease them in other ways. This new world has an evolution of stakeholders, and so making sure that everyone is on the same page in terms of, do you want to work with a utility? Do you not? How do you package the deal as being in everyone's best interest when sometimes you're really trying to change a large company's business model, or help erode their business model. So in the case of utilities, so it's tricky. And then when you bring in debt and equity to the table, everyone has different sensitivities around who's holding the cards. So that's the hardest part. Finding the money is not the hard part. It's getting everyone on the same page that they want to do a certain transaction. That's the hard part.
Can I ask Miriam a quick question?
Yeah.
So you mentioned microgrid.
Yeah.
And I've heard of the promise of blockchain in that context. Is that filtering through what you're doing yet, or is it not yet mature?
We're still at such an early stage on microgrids that the real issue is valuing the different benefits of a microgrid and valuing resiliency. And until you can figure out the real financial value, the way that the cash moves is not as important as getting those initial pieces in. So everyone wants resiliency. Folks don't know what it's worth. It's a nice to have, but resiliency in the energy world means you're way overbuilding. So overbuilding for normal day-to-day use. So it's a great thing to have a microgrid and to be able to island and be able to operate if there's a natural disaster. But who's willing to pay for that benefit is still undetermined. And so until we can get those pieces down, I don't think we're ready to really talk about blockchain in the same way that we can talk about blockchain in solar or wind or kind of a cleaner, more established asset class.
I think my time is up. I want to thank our panelists and let the next group speak. Thank you.